Welcome to the Explainer. If you've ever looked around your neighborhood and wondered why megabanks are suddenly taking such a massive interest in your local real estate market, well, you are in exactly the right place. Today, we're going on a bit of a detective journey to unpack the fascinating and frankly enormous economic mechanics driving JP Morgan Chase's brand new housing initiative. We are going to find out exactly who is buying up the American dream. Okay, let's just jump right into this staggering number. $750 billion. I mean, when I first read that, I literally had to double check the zeros. JP Morgan is committing this massive pile of cash through 2035 to drastically boost the US housing supply. To put that into perspective, that represents a 40% increase in the bank's housing capital deployment compared to the entire previous decade. We're talking about an absolute tidal wave of capital flowing directly into real estate, and it is fundamentally changing the game. They're packaging this mountain of cash under what they're calling their American Dream Initiative, and the headline goals here are pretty incredible. They're targeting the financing of 1 million affordable housing units and actively helping 500,000 people actually achieve homeownership, including about 200,000 first-time buyers. But here's the really revealing part of their strategy. To pull this off, they're boosting their mortgage lending by 40% and adding 850 brand new home lending advisors to their payroll. That isn't just a minor expansion. That is a massive corporate hiring shift that tells us exactly how serious they are about capturing this market. But why are they doing this right now? Well, the reality driving this push is, frankly, a tough pill to swallow. As of June, the median price for an existing home in the U.S. hit an all-time record of $440,660. In practical, everyday terms, that means the traditional financial milestones are just rapidly slipping away for the average person. The whole concept of a basic starter home is essentially vanishing. Right now, over 60% of non-homeowners are completely priced out of buying even a modest first house. It's basically a broken link in the traditional path to middle-class stability. And the root cause of this brutal affordability crisis? A nationwide shortage of roughly 4.5 million homes. Just pause and think about the sheer scale of that deficit for a second. That is essentially several major American cities' worth of housing that simply does not exist. We have millions of families fighting over the shrinking pool of available inventory. But to really understand Wall Street's trillion-dollar solution to this problem, we've got to look at the mechanics of how we actually got into such a massive hole in the first place. So, how did we get here? We actually have to rewind the clock back to 2008. After that devastating crash, home prices completely collapsed, and developers just stopped building because it simply wasn't profitable anymore. Understandably, investors fled what was widely seen as a highly toxic market. But crucially, for the entire decade that followed, literally right up until 2021, the Federal Reserve maintained near 0% interest rates. Now, while that sounds fantastic if you're an everyday borrower, it created a huge problem for institutional lending. When rates are that incredibly low, housing just isn't a very lucrative investment for massive financial institutions. There simply wasn't enough profit in lending money to incentivize a massive wave of new home construction. So think about it. If the market has been broken, severely underbuilt, and pretty much ignored by mega banks for over a decade, why the sudden change of heart? Why is a major bank like JP Morgan so eager to step into this mess with massive capital right now? Well, the answer boils down to the definitive end of the era of cheap money. This was that historical economic period post-2008 where central banks kept interest rates artificially near zero. Think about it from the perspective of a mega bank's business model, loaning out hundreds of thousands of dollars to a family and locking up that capital for 30 years at a mere 3% interest rate. It just didn't yield enough return. When you factor in inflation and other things they could be investing in, a 3% return just doesn't justify the enormous multi-billion-dollar investments required to actually fix the housing market. Let's break down the raw, undeniable math on a standard home purchase, because this is where it gets really fascinating. Imagine a standard $440,000 median home, putting 20% down. At yesterday's 3% mortgage rate, a buyer's monthly payment was comfortably under $1,500. Over 30 years, that yields the bank about $182,000 in total interest. But at today's 6.8% rate, the monthly payment jumps to around $2,300. And more importantly for the bank, the total interest paid skyrockets to $471,000. The underlying financial incentive of this entire transaction has completely flipped. So what does that mean in the grand scheme of things? It means that simply by waiting for the macroeconomic environment to shift, banks are now raking in over 2.5 times more profit on the exact same brick-and-mortar house. Same exact risk, same exact asset, but massively higher returns.
Loaning money to homebuyers is suddenly a highly lucrative business model again.
And JP Morgan, well, they're strategically positioned to capitalize on both sides of this lucrative new equation. This isn't just about handing out consumer mortgages at the finish line. Oh no, they are providing the massive capital loans to the developers required to actually get the houses built in the first place, making a solid profit on the construction phase. Then, they turn right around and issue those highly profitable 7% mortgages to the families who eventually buy them. It's a closed-loop profit system. Honestly, it's a brilliantly calculated double play.
Now, with all this new money and impending construction on the horizon, you might naturally feel a little sense of déjà vu. I mean, anyone who lived through 2008 hears the phrase massive bank housing initiative and immediately thinks, wait, are we just flooding the market with too much supply? Is this going to create an oversupply crisis and trigger another housing bubble collapse? But the data tells a totally different story this time around. A crash is actually highly unlikely. Right now, 65% of potential buyers are completely sidelined by these high prices. This means we aren't facing a lack of qualified buyers. Instead, there is massive guaranteed pent-up demand. We aren't talking about speculative house flippers here. We're talking about desperate families waiting in the wings, ready to jump at the absolute first sign of available inventory that they can actually finance. On top of that, the crucial thing keeping the existing housing supply so incredibly tight right now is what we call the lock-in effect. Back in the early 2000s, the old mentality was, I'm not selling because prices are definitely going to jump another 15% next year. Today's reality is completely different. Imagine you bought a house in 2019 at 3%. If you move across town today to buy a very similar house, your monthly payment might literally double just because of the new 7% rate. So what do? You lock your doors and stay put. Sellers aren't holding out for higher prices anymore. They are simply refusing to trade in their cheap mortgage for a ridiculously expensive one.
And those higher rates, they might be sticking around for the long haul. Why? It's a three-step macroeconomic reality. First, ongoing geopolitical tensions are keeping inflation sticky, meaning the Federal Reserve can't just easily slash rates back to zero. Second, massive government debt requires constant refinancing. And third, to attract buyers for that massive debt, U.S. Treasury bonds have to offer higher yields, currently sitting around 4.7%. Think of Treasury bonds as basically a risk-free investment. If the government is paying almost 5% for a risk-free loan, a bank is absolutely going to demand a significantly higher rate, like 7%, to take on the risk of giving you a 30-year mortgage.
So when you strip away the polished PR messaging of the American Dream Initiative, you're left with cold, hard, lucrative math. As financial commentators are pointing out, the underlying reality of this $750 billion initiative isn't just corporate goodwill. The era of cheap money is officially over, and the business of loaning money finally heavily rewards the massive institutions that can deploy capital at scale. We are literally living through a fundamental changing of the guard in real estate wealth. The biggest winners in the housing market are transitioning away from the everyday homeowners who, for decades, enjoyed passive, rapid price appreciation. Instead, that massive wealth generation is shifting directly over to the massive financial institutions who are earning lucrative 7+% interest on long-term loans. It is a complete rewiring of who actually profits from the American neighborhood. So, as Wall Street steps in to completely reshape the housing landscape with this monumental $750 billion initiative, it leaves us with one incredibly provocative question for your own financial strategy. In this new high-rate environment, will you be buying the home, or will you be investing in the banks that fund them? Thanks for joining me on this explainer. I really hope this helps you understand the massive forces shaping our housing market today.